Hello and welcome again to another edition of the 12 Days of Crop Insurance. I am your host, Ben Spirk with Jones Bank. Today we're going to take a little bit closer look at production hail and how that policy's coverage works. So let's go a bit further when we talk about production hail and how it differs from your standard crop hail policies. Now I just want to make clear it does not differ in terms of what it actually covers against. This would be your fire, lightning, hail, transit to the first place of coverage, as well as any wind endorsements you would want to elect to put on the policy. Where it differs is how it determines what the total liability is for a given field. With a standard crop hail policy, what you do is you elect a dollar per acre amount of coverage plus the type of coverage you want. With production hail, what we actually look at is we take your approved yields from your own personal MPCI policies, incorporate them into a production hail policy, and then you purchase so much of your approved yield and so much of the projected price. So for example, let's say that you have 100 bushel an acre yield on corn and you want to purchase 120% of that yield. And you only want to purchase, say, 75% of the projected price. So in this example, we'll say it's 100 bushel an acre corn approved yield. So because you're purchasing 120% of that, your approved yield on this policy is actually 120 bushel an acre. Now we did elect 75% of the projected price. So we'll say it was $4 to keep it simple and drop it down to $3, right? From there, what you're going to do is you take your 120 approved yield times the projected price that you're covering, so 120 times 3. Then you take that times the amount of acres in a field for corn units, and that's how you come up with the total liability on a per field basis. Production hail is a very beneficial tool to use to help mitigate risk on a farm. It utilizes your already in place MPCI policy and approved yields, and so it gives a bit better coverage than a standard crop hail policy in that sense. It also pays out much quicker than your standard crop hail policies. The only downside really is because it pays out faster and it increases the coverage, gives you a greater coverage amount usually. It does cost a fair amount more than your standard crop hail policies. But again, it is quite a good tool to use to really help mitigate any risk in your farm operation. So thanks for joining us on another edition of our 12 Days of Crop Insurance, where we discuss production hail. As always, I am your host, Ben Spirk with Jones Bank, reminding you to be well, live well, and insure well.